The morning of Friday, March 10th, 2023, in Menlo Park, California. The sun was already up over Sand Hill Road. The coffee in the lobby of 333 Mission Street was still warm, and by 11 a.m. Pacific, agents from the Federal Deposit Insurance Corporation were walking through the front doors of Silicon Valley Bank, badges out, taking control of the 16th largest bank in the United States. 24 hours earlier, depositors had tried to pull $42 billion out of that bank in a single day. $42 billion in one day. Roughly a quarter of the entire institution's deposit base attempted to walk out the door between sunrise and sunset on a Thursday. It was the second largest bank failure in American history at that moment. $209 billion in assets, gone into receivership before most of the East Coast had finished lunch. And it was only the middle bank in a 72-hour sequence that would take down three institutions, force a fourth across the Atlantic into a shotgun marriage with its largest rival, and end 8 weeks later with a fifth bank, First Republic, being sold to J.P. Morgan Chase for parts. This is the timeline of those 72 hours and the 8 weeks that followed, reconstructed from the wire feeds, the regulatory filings, the joint statements, and the public record. What happened, in what order, and why a system that had spent 15 years rebuilding itself after 2008 discovered over one weekend in March that it had been quietly recreating the same fragility in a different shape. Start with what these banks actually were, because in the headlines that followed, they got flattened into a single category: regional banks, mid-sized banks, victims of the rate cycle. But each one was a specific institution serving a specific clientele. And the specifics are why the runs moved as fast as they did. Silicon Valley Bank, founded 1983, was the banker to roughly half of the venture-backed startups in the United States. If a software company in San Francisco raised a Series A in 2021, there was a very good chance the wire instructions on that funding round pointed to an account number at SVB, payroll, vendor payments, the seven-figure operating balances of pre-revenue companies. That was the franchise. By the end of 2022, SVB held over $170 billion in deposits. Signature Bank, based in New York, had built a quieter but equally concentrated business: commercial real estate lending in the New York metropolitan area, private banking for law firms and accounting partnerships, and, in the years leading up to the crisis, a substantial book of business with cryptocurrency exchanges and digital asset firms. Signet, its proprietary real-time payments platform, had become one of the main on-ramps and off-ramps between dollars and crypto. The bank ended 2022 with roughly $110 billion in assets, and Silvergate Capital, based in La Jolla, California, was effectively the crypto industry's primary bank. The Silvergate Exchange Network, its own 24/7 settlement rail, handled the dollar leg of trades between exchanges, market makers, and institutional crypto desks. When FTX collapsed in November 2022, a meaningful share of FTX's banking relationships had run through Silvergate. 3 different banks, 3 different concentrated depositor bases, tech and venture capital at SVB, crypto and commercial real estate at Signature, crypto almost exclusively at Silvergate, and all 3 of them, in different ways, were about to discover what concentration risk looks like when the depositors all share the same group chats. Now back up to where this actually starts, which is 2020 and 2021. The deposit boom, when the Federal Reserve cut its policy rate to near zero in March 2020 and began purchasing assets at a pace not seen since the financial crisis. The consequences rippled out through every part of the financial system. For the venture capital ecosystem in particular, the years that followed were a flood. Fundraising rounds got bigger, valuations stretched, special purpose acquisition companies, SPACs, became briefly the dominant vehicle for taking companies public. Crypto prices ran, and every dollar of that activity had to live somewhere between the moment it was raised and the moment it was spent. A lot of it lived at Silicon Valley Bank. Internal disclosures and later regulatory filings showed SVB's deposit base nearly tripling in roughly 18 months from somewhere around $60 billion at the end of 2019 to almost $200 billion by early 2022. That is an extraordinary inflow. And I'm choosing my words carefully here because the volume of money is the entire story of what happened next. A bank that receives that much deposit growth that quickly has to do something with it. Loans take time to underwrite. The startup customer base, almost by definition, was raising money rather than borrowing it. So SVB did what risk-averse balance sheets do. It bought what are supposed to be the safest assets on Earth: long-duration United States Treasury securities, agency mortgage-backed securities, the bonds backed by Fannie Mae and Freddie Mac, themselves backed by the implicit credit of the federal government. Held-to-maturity bonds, the kind of paper that under accounting rules sits on the balance sheet at its purchase price, not its market price, as long as the bank intends to hold them until they mature. In a low-rate world, that is a quiet, profitable, boring trade. You take in deposits paying near zero. You buy 10-year treasuries yielding 1.5%. You keep the spread. Boring banking. The kind of trade 1,000 institutions had on in some form. The kind of trade the regulators looked at and saw nothing alarming. But boring trades have a hidden assumption baked into them. The assumption is that interest rates stay roughly where they were when you put the trade on. Which brings us to 2022 and the Fed. Inflation had moved from a transitory talking point to a sustained problem through 2021. By March 2022, the Federal Open Market Committee began what would become the most aggressive tightening cycle since the early 1980s. 25 basis points in March, 50 in May, 75 in June, 75 in July, 75 in September, 75 in November, 50 in December. By the end of 2022, the federal funds rate sat in the 4.25% to 4.5% range, up from effectively 12 months earlier. By March 2023, it would be at 4.75%. Now, here is what that does to a long-duration bond portfolio. When market interest rates go up, the price of existing bonds issued at the old lower yields, goes down. The math is mechanical. A 10-year treasury yielding 1.5% in a world where new 10-year treasuries yield 4% has to trade at a discount steep enough to give the buyer that 4% yield to maturity. The longer the duration, the bigger the price hit. Across the United States banking system, that mark-to-market loss on bonds held by banks was estimated by the FDIC itself at roughly $620 billion in unrealized losses at the end of 2022. $620 billion, most of it concentrated in those held-to-maturity portfolios that, on a balance sheet, still looked perfectly fine. The losses were real. They just hadn't been recognized because the bonds hadn't been sold. This is where Wednesday, March 8th, comes in. That afternoon, Silvergate Capital announced it would wind down operations and voluntarily liquidate the bank. The crypto industry's primary banking relationship was, effectively, gone. The press release was orderly. The market reaction was not. Crypto markets sold off. Banking analysts started asking which other institutions had concentrated exposure to digital asset depositors. Later that same evening, Silicon Valley Bank's parent company filed an 8K disclosure with the Securities and Exchange Commission. Two pieces of news. First, The bank had sold roughly $21 billion of available-for-sale securities at a loss of approximately $1.8 billion in order to reposition its balance sheet. Second, the bank was launching a capital raise, selling stock and convertible preferreds to fill the hole. In a different era, that announcement might have been digested over weeks. Analysts would have published notes. The trade press would have explained what duration risk meant in plain English. Investors would have had time to react. That is not what happened. What happened instead was that within hours, the Slack channels of the venture capital community, and you have to understand, these are private channels with hundreds of partners, principals, founders, CFOs, started lighting up. WhatsApp groups, Twitter, which by then had been rebranded as X, group chats among portfolio CFOs. By Thursday morning, March 9th, a handful of prominent venture capitalists were publicly and privately telling their portfolio companies to move money out of Silicon Valley Bank. Wire it. Wire it now. Wire it before the close of business today. This is the modern parallel I want to surface, and it matters for understanding everything that came after. In 1933, when banks failed, the run looked like a line of people on a sidewalk in front of a branch, sometimes for blocks. The bank could see it. The neighbors could see it. The newspaper photographer could see it. There was a physical bottleneck, the number of tellers, the speed of cash counting, the hours the doors were open. A run took days, sometimes weeks, to fully materialize. In 2008, when Washington Mutual failed and Wachovia teetered, the ideal runs were faster, phone calls, online transfers, but they still took place over weeks. The IndyMac collapse in July of 2008 produced lines on the sidewalk in Pasadena. The Lehman weekend in September was a slow-motion catastrophe that the public watched build for days. In March of 2023, the run on Silicon Valley Bank happened in a single business day. The Slack channels and the venture capital group chats were the fiber-optic version of the lobby queues of the 1930s, except they moved at the speed of a notification. They were invisible to the bank until the wire requests started hitting the systems, and the coordination problem that had previously slowed runs down had been replaced by a coordination engine that sped them up. By Thursday afternoon, March 9th, depositors had submitted wire transfer requests totaling approximately $42 billion in a single day. The bank could not meet that. No bank could have met that. The available-for-sale sale on Wednesday had been an attempt to raise liquidity, but it was a small fraction of what was now being demanded. The capital raise that had been announced Wednesday evening collapsed by Thursday evening. No investor wanted to write a check into a bank that was actively bleeding out. SVB's stock fell roughly 60% in a single trading day. By Thursday night, internal estimates put the cash balance at the close of business at negative roughly $1 billion. The bank was insolvent on a liquidity basis. By Friday morning, March 10th, the California Department of Financial Protection and Innovation closed Silicon Valley Bank and appointed the FDIC as receiver. It happened before 9 a.m. Pacific. The FDIC officials in the lobby on Page Mill Road, the signs going up, employees arriving for work and finding out, in some cases from news alerts on their phones, that their employer had been seized overnight. And here is what I want to stop and say plainly, because the next part of the story is the part the cable news coverage focused on. But it isn't the whole story. This is what a bank run looks like in 2023. It is not a line of people on the sidewalk. It is a notification on a phone. Zawarit is a group chat that pivots in 15 minutes. It is a CFO at a 30-person startup in South San Francisco, refreshing the SVB online portal at 1 p.m. on a Thursday and watching the wire transfer queue grow longer. It is, on the human side, a payroll administrator at a biotech company realizing that the funds for Friday's checks are stuck in a bank that no longer exists in any functional sense. Over the weekend of March 11th and 12th, that human side became the dominant political story. Estimates at the time suggested that something on the order of 90% of SVB's deposits were uninsured, meaning above the FDIC's standard $250,000 limit per account. Because SVB's customer base was companies, not individuals, the typical operating balance was in the millions or tens of millions, not the thousands. If the standard FDIC resolution played out, insured depositors paid in full, uninsured depositors waiting for the eventual proceeds of the receivership, thousands of startups were going to miss payroll the following Friday, Sunday, March 12th, late afternoon. A joint statement from the Treasury Department, the Federal Reserve, and the FDIC, all depositors of Silicon Valley Bank, insured and uninsured, would have full access to their money beginning Monday morning. The same protection would apply to a second institution that had just been closed that same Sunday by the New York Department of Financial Services, Signature Bank, the $110 billion New York institution with the heavy commercial real estate book and the crypto-friendly platform. Signature had seen its own deposit outflows accelerate on Friday in the wake of the SVB news. By the weekend, regulators decided not to wait. The same Sunday statement announced the creation of the Bank Term Funding Program, the BTFP, a new Federal Reserve facility that would allow eligible banks to pledge treasuries and agency MBS at par value, not market value, in exchange for one-year loans. In effect, the Fed was saying to the banking system, if you are sitting on long-duration bonds that have lost value because of our rate hikes, we will lend against them at their original price, so you do not have to sell them at a loss to meet deposit outflows. That backstop, more than the depositor guarantee, is arguably what stopped the contagion from spreading to dozens more regional banks the following week. But the story did not stop at the United States border. By Wednesday, March 15th, the second largest Swiss bank, Credit Suisse, an institution founded in 1856, a globally systemically important bank with roughly 570 billion Swiss francs in assets, was visibly in distress. Its stock was falling. Credit default swaps on its debt blew out to levels not seen even during the European debt crisis. The bank had been struggling for years through a sequence of scandals, restructurings, and management changes, but the March banking turmoil pushed it over the edge of market confidence. By Sunday, March 19th, just 9 days after the FDIC walked into SVB, Swiss regulators announced that UBS, Credit Suisse's century-old crosstown rival, would acquire Credit Suisse for roughly 3 billion Swiss francs in stock in a deal structured and pressured by the Swiss National Bank and FINMA, the Swiss financial regulator. The Swiss Central Bank pledged emergency liquidity. The two largest Swiss banks became one. 167 years of independent corporate history ended on a Sunday afternoon in Zurich. And it was still not over. First Republic Bank, a San Francisco institution that catered to high-net-worth individuals on both coasts with a famous reputation for white glove service and very cheap jumbo mortgages, had been bleeding deposits since the SVB news. In mid-March, 11 of the largest United States banks deposited a combined $30 billion at First Republic in a coordinated show of support, an attempt to stabilize the bank without a formal government intervention. It bought time. It did not buy a solution. Through April, First Republic's deposit numbers got worse, not better. The quarterly earnings release at the end of April showed roughly $100 billion in deposit outflows in the first quarter, out of a base that had been around $176 billion. On Monday, May 1st, the FDIC announced that First Republic had been placed into receivership and sold to JP Morgan Chase, $229 billion in assets at the time of failure. That made First Republic, not SVB, the second largest bank failure in United States history, a record it would hold, surpassed only by Washington Mutual in 2008, so the count by the end of that period. Silvergate, wind down, SVB, receivership and FDIC managed sale of assets. Signature, closed by state regulators and sold in pieces. Credit Suisse, absorbed by UBS. First Republic, sold to JP Morgan Chase. 5 institutions, 2 countries, 8 weeks. The combined asset base affected was somewhere north of $1 trillion. The aftermath shaped the rest of 2023 in ways that are still being argued about. The Bank Term Funding Program ran through March of 2024, and at its peak in early 2024, it had outstanding loans exceeding $160 billion. The implicit message of the joint Sunday statement, that uninsured depositors at any sufficiently large bank would, in practice, be made whole, was never formally extended into law, but it changed how depositors, especially corporate treasurers, thought about deposit insurance. The largest United States bank saw deposit inflows in March and April as customers consolidated relationships toward institutions perceived as too big to fail. The mid-size banking sector saw its market valuations crater and, in many cases, never recover to their early 2023 levels. The moral hazard debate is the one the policy community is still having. If the implicit guarantee covers everyone, what discipline does the deposit market impose on bank management? If a bank can take in concentrated deposits, buy long-duration bonds, ignore duration risk, and know that when the run comes, the federal government will backstop the depositors, what stops the next bank from running the same play? On the other hand, the counterfactual the regulators were staring at. On the night of Sunday, March 12th, was a chain of midweek failures across the regional banking sector, with thousands of small and medium businesses unable to make payroll. The choice they made was the choice they made. The argument about whether it was the right one continues. Now, to the modern warning. Because this story is not entirely a closed chapter, it is, more accurately, a chapter whose final pages have not yet been written. The $620 billion in unrealized losses on bank balance sheets at the end of 2022 did not disappear. The Federal Reserve held rates at 5.25% to 5.5% for most of 2023. Through 2024, even as the Fed began cutting, those long-duration bonds still on bank balance sheets, purchased at the rock-bottom yields of 2020 and 2021, continued to sit at significant unrealized losses. FDIC quarterly banking profiles through 2024 documented hundreds of billions of dollars in unrealized losses still on the books. The losses are smaller than the 2022 peak, but they are not gone. In late January 2024, New York Community Bancorp, NYCB, reported a surprise fourth-quarter loss tied to its commercial real estate exposure and its acquisition of part of the former Signature Bank franchise. The stock fell roughly 40% on the news. Through February and into March of 2024, NYCB's stock continued to decline. Deposit outflows accelerated, and the bank ultimately secured a $1 billion capital infusion led by former Treasury Secretary Steven Mnuchin's investment vehicle to stabilize the franchise. The bank survived. The episode reminded the market that the conditions that produced March 2023 had not been fully cleaned up. And then there is commercial real estate. The shift to hybrid and remote work that began in 2020 pushed office vacancy rates in major United States cities to historic highs. Office building valuations in several markets fell sharply. A meaningful share of commercial real estate loans, many of them 5-year or 10-year balloon structures originated in the low-rate years, are scheduled to refinance through 2025 and 2026. Those refinancings, in many cases, would be at materially higher interest rates against materially lower collateral values. Regional banks, broadly speaking, hold a disproportionate share of commercial real estate exposure relative to their share of overall banking system assets. None of this means another bank failure is imminent. It does not mean any specific institution is in trouble. The post-March 2023 regulatory response has tightened liquidity requirements for many mid-sized banks, and the BTFP, while now closed to new loans, gave the system time to absorb the worst of the duration mismatch. The largest banks remain, by every regulatory metric, far better capitalized than they were in 2008. But the question that the events of March 2023 put on the table, whether the regional banking model that grew up in the long era of zero interest rates is durable in a world where rates can move 4 percentage points in 12 months and depositors can coordinate a run in a single afternoon, is not a question that has been resolved. It is a question that the system has, so far, postponed. Was March 2023 the beginning of a longer regional bank reckoning, or was it the only act? That is the question that the next chapter, the one being written now in the held-to-maturity disclosures of every quarterly call report, in the maturity schedules of every commercial real estate loan book, in the deposit composition of every mid-size regional bank, will eventually answer. I do not know the answer. The people running the institutions involved do not, in many cases, fully know the answer. The Federal Reserve's own internal post-mortem on the SVB collapse, released in late April 2023, acknowledged supervisory failures and called for stronger oversight of mid-sized banks. Whether that oversight prevents the next episode, or whether the next episode takes a shape the current rules did not anticipate, is a story still in progress. What we know is the sequence. Wednesday, March 8th, Silvergate winds down. Wednesday evening, SVB announces the bond sale and the capital raise. Thursday, March 9th, $42 billion of attempted withdrawals. Friday, March 10th, the FDIC walks into Menlo Park. Sunday, March 12th, signature closed, depositor backstop announced, BTFP created. Sunday, March 19th, Credit Suisse absorbed by UBS. Monday, May 1st, First Republic sold to JP Morgan Chase. 72 hours that became 8 weeks that became, in many ways, the defining banking story of the decade so far. If you found this useful, the next reconstruction on this channel walks through the savings and loan crisis of the 1980s. A different era, a different cast of institutions, a different set of regulators, and yet a pattern of long-duration assets, rapidly changing rates, and deposit behavior that, in hindsight, will sound familiar. Until then, take care